Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Annabel Duncan from JP Morgan.
Good morning.
Hi Annabel.
Hi.
So we're here today to talk about pensions. It's part of our active and passive week, and I thought we could talk about what the professionals are doing to save for their customers, their clients, investors' retirement, and what investors can learn from that. So with that in mind, what are professional investors, DC pension schemes using active and passive in order to hit retirement goals?
Well, I think the answer really to that is that they're using a combination of both. Plans for a long time now have used both passive equities, for example, and then maybe more active strategies like DGFs, and they've used a range across fixed income and emerging markets, for example.
And is it about picking products for specific goals? Does it change as people approach retirement? Or is it sort of best use for individuals?
I think really it's about thinking about the whole journey rather than just one point in the glide path. And I think that the important things that you need to remember are about diversification benefits. And there will be certain types of investment that are more easily or more efficiently done through an active approach, and maybe others that you could look at either active or passive.
And of course, JP Morgan Asset Management is an active house, but looking at the sort of retirement solutions part of the business, you do say that passives have a place in retirement planning.
Absolutely. I think the debate needs to stop being quite so religious. It's not one or the other. And I think particularly in light of the charge cap, it's important that when you're thinking about a glide path that you think both about the costs and the impact that will have on the people saving, but also thinking about the diversification that you need to get from different types of investments.
And you touched there on the charge cap. This was something that was initially introduced and then pushed back, but it is still quite a new concept. It's 0.75%, and that for a lot of people has alarm bells ringing that it will restrict what people can hold within their pension plan. It'll mean that perhaps some fantastic, though expensive fund managers or asset classes which are slightly more illiquid and so may cost more, such as commodities or alternatives, may no longer be able to be part of a person's pension plan. And what do you say to that?
I think it's true, and I think it is a challenge. It is clearly still possible to be able to deliver a broad level of diversification within the charge cap, and you have to remember that there are administration costs as well that are included within that 0.75. However, I think it is important to recognise that there will be asset classes that it will be much more difficult for plans to include, for their members to be able to benefit from that higher alpha, as you say, or diversification.
And if it's something that you're concerned about as an individual, you always have the option to move out of the default, because this charge cap only does apply to default pension schemes. Is that right?
That's absolutely correct. I think the thing that people who are saving need to think about is whether or not they're going to be better placed outside of the default. Will they look at their pension regularly? Do they feel comfortable managing their own investments for such a long time horizon, 40, 50, 60 years? And do they feel that they're going to do that regularly and make sure that they're checking in? So
perhaps not for everybody, but if you are an informed investor who is worried about the restrictions a charge cap may imply, then it's an option.
Yes, absolutely. I think it is an option. What we've seen, however, generally in the UK market, though, is that it's a very small percentage of people who feel comfortable doing that. And typically there is a good governance structure in place with your work-based pension, and they will be looking at those things like diversification and value for money and thinking about those long-term goals.
Annabel, thank you very much.
Thank you very much.
This is Emma Wall for Morningstar. Thank you for watching.